This is video T6C and covers the accrual method from Chapter 6. Like the cash method, the tax rules take something we understand reasonably well, accrual-based accounting, and make it difficult. Well, let's get going. The accrual method for tax is similar to the accrual method for books. Most businesses that keep GAAP financial statements will adjust book income to get to taxable income through a series of book-to-tax adjustments. Similar to the cash method, the tax law contains rules about when to recognize income and when to recognize deductions. Under the accrual method of accounting, income is includable when all the events have occurred which fix the right to receive such income, and the amount can be determined with reasonable accuracy. This occurs at the earliest of the income is earned or the payment is received. Let's read an example about one of my favorite restaurants. In summary, a gift card is bought in 2015 and redeemed in 2017. On the left are the book accounting entries. We record unearned revenue with the receipt of the cash in 2015. Then in 2017, when the card is redeemed, the unearned revenue is converted into revenue. However, the right side of the table covers the tax entry. Under the all events test, the income is included when received. Yep, even for an accrual-based taxpayer. Although they are not shown, the cost of goods sold or cost of services is recognized in 2017 for both book and tax. This is some really bad matching, and the accountant in me is rolling over in my grave. Except I'm not dead. Well, at least I hope I'm not. Well, anyway, it's bad matching. The good news is that the tax code permits a taxpayer to defer income in instances where the advance payment is for goods or services. The rules require that the income be recognized when it's either recognized for books, but never later than the year after the advance payment is received. Thus, if we revisit our earlier gift card example, the book entries do not change, but under the deferral method for tax purposes, the income can be deferred for tax in 2015, but must be recognized no later than the year after, in this case, 2016. Deductions are recognized under an all events test also, but there is an added requirement known as economic performance.
Learn it, know it, live it.
Generally speaking, economic performance is the delivery of services or goods, or if related to rents, the use of the property over time. There is a category of deductions called payment liabilities. Payment liabilities are only deductible when paid, even for an accrual-based taxpayer. Payment liabilities include workers' comp claims, torts, rebates, refunds, prizes, and awards. Take a moment to read this example. Because prizes are a payment liability, the expense is only deductible when paid. So General Kills will deduct $10,000 per year starting in 2017. One important exception to the general rules is related to compensation. An employer can accrue compensation costs as long as the actual payment is made within 2.5 months after year end. For a calendar year end, that's by March 15. Lastly, bad debts are not deductible for tax purposes until actually written off. Typical book accounting is to record an allowance for doubtful accounts. This allowance is not deductible for tax.
This brings us to the end of video T6C on the accrual method for tax. Thanks for watching. Hey Dad, quit hanging from the ceiling.